Think back to the last massive buzzword that took over your social feed. Clean energy in 2020, cannabis in 2018, the metaverse in 2021, AI today. Every time a sector catches fire, Wall Street rushes out a shiny new product, the Thematic ETF. They market it as the ultimate shortcut to investing in tomorrow's revolution without picking individual stocks. But academic research shows that buying thematic ETFs is one of the most reliable ways to underperform the broad market. Today we are dissecting the financial engineering machine behind thematic ETFs, why they are built to peak at launch, how ETF issuers profit off your FOMO, and the data that proves why you should almost never buy them. To understand why thematic ETFs fail, you have to understand how an ETF actually gets created. ETF issuers like Global X, BlackRock, or State Street are businesses. They do not make money by making you rich. They make money by collecting assets under management fees. By the time an ETF issuer designs the index, gets regulatory approval, hires market makers, and launches a massive marketing campaign, the underlying trend has usually been running for 1 to 3 years. The stocks inside that ETF are no longer undiscovered gems. They are at peak valuation, priced for perfection, and held up purely by speculative mania. You aren't buying the ground floor of an innovation. You are buying the penthouse suite at top of market prices. Take clean energy. In 2020, solar and green energy stocks went parabolic due to zero interest rates and green policy enthusiasm. Billions poured into clean energy ETFs at the absolute peak in early 2021. Over the next 3 years, while the S&P 500 climbed to all-time highs, many clean energy and solar ETFs lost more than 50 to 70% of their value. Solar power grew in adoption, but the ETF crashed because valuations collapsed. Or look at cannabis ETFs. Around the 2018 Canadian legalization and 2021 legislative buzz, retail investors pour hundreds of millions into funds like MJ and YOLO. Today, those funds are down over 80% from their peaks. The industry grew, but oversupply, price wars, and regulatory bottlenecks crushed company earnings. Why do these funds bleed money so consistently? It comes down to three structural flaws. Outrageous expense ratios. A standard S&P 500 ETF costs 0.03%. Thematic ETFs routinely charge 0.65 to 0.85%. You are paying active management level fees for a passive marketing basket. Number two, illiquidity and index crowding. When billions flood into a narrow theme, the ETF is forced to buy tiny small cap companies that have low liquidity. This artificially drives their stock prices into the stratosphere. When retail investors panic sell, the ETF is forced to dump those illiquid shares, causing an exaggerated crash on the way down. Number three, forced buy-high, sell-low rebalancing. Most thematic ETFs track rules-based indexes that rebalance semi-annually. When a stock has skyrocketed, the index gives a huge weighting right at the peak. If a company stumbles, it gets booted out after it already crashed. This isn't just bad luck, it's empirically proven. A famous study by the European Corporate Governance Institute and Ohio State University analyzed over 25 years of thematic ETF launches. Their findings were brutal. Thematic ETFs launch on average after an underlying sector has already generated astounding 120% return over the prior 3 years. Over the first 5 years following launch, the average thematic ETF underperformed the broad market by about 4 to 5% per year on a risk-adjusted basis. More than 1/3 of all thematic ETFs close down and liquidate within 5 years because asset under management dry up after the crash. Does this mean you should never invest in transformative technology? Absolutely not. If you truly believe AI, clean energy, and robotics is the future, here's the secret. The broad market indexes already own them. A standard S&P 500 or Nasdaq 100 ETF naturally captures the winners of every technological revolution without charging you 0.75% fees or forcing you to time the exact top of a hype cycle. If a theme succeeds, the real winners will grow to dominate the broad index automatically. The next time Wall Street drops a flashy new thematic ETF with a catchy ticker and a hot marketing video, ask yourself, are you investing in an economic reality, or are you just buying the top of a marketing funnel?